Today is Saturday, February 28th, 2026. And I am willing to bet that somewhere in your immediate periphery right now, there is a screen glowing with a very specific, highly engineered shade of warning red.
Yeah, that breaking news red.
Exactly. Depending on where you're sitting, you might be, watching rolling news coverage on mute at a bar or listening to the sirens in the background of a live broadcast.
Right.
The geopolitical chessboard has been violently shaken. Tensions between the U.S. and Iran have reached an absolute boiling point, and the entire world is collectively holding its breath.
You really can feel the tension in the air. I mean, it permeates everything.
It does.
When you walk into a coffee shop right now, people are they're staring at their phones with this shared quiet anxiety.
Yeah.
The news anchors have dropped their normal cadence and shifted into that hushed, grave register they reserve for historical moments. We are standing on the edge of a precipice, and the uncertainty is just paralyzing for the average person.
But the reality of what's happening on those screens is triggering a completely different reality behind closed doors.
Completely different.
We have a massive stack of forensic financial notes, macro analyses, and institutional playbooks sitting on the desk between us today. And the mission of this deep dive is to open up the file on exactly what institutional capital is doing right now while the rest of the world is glued to the breaking news. We are looking at a hyper-specific, ruthlessly efficient playbook known in institutional circles as the crisis trade. I'm looking at the cold, hard math of it, the liquidity flows.
But I'm sitting here wrestling with the implications of it. Because a contrast in human behavior here is genuinely jarring.
It's night and day.
When those red banners flash across the screen, the average retail investor, the everyday person with a 401k or a modest brokerage account, reacts with pure, unadulterated emotion.
Panic.
They see the geopolitical instability, they visualize the worst-case scenarios, and the immediate psychological response is a desperate need for safety.
Right, so they log in.
They log into their accounts, they see a sea of red numbers, and the instinct is to stop the bleeding at any cost. So they sell.
They panic sell.
They liquidate their portfolios at the exact moment the market is crashing.
You look at the data flowing in today, and you can see that retail panic happening in real time. But here is the cold, hard, forensic truth that we're going to track today. The so-called smart money.
The hedge funds.
Right. The massive hedge funds, the sovereign wealth funds, the institutional giants, they do not watch the news to feel emotion.
No, they definitely don't.
They don't look at a graphic of a missile deployment and feel fear. They watch the news for one singular reason.
To track the flow of liquidity.
Exactly. For them, chaos is not an anomaly in the financial system. It is the primary catalyst for massive wealth transfer.
Well, hold on. We have to pause and address the sheer cynicism of that reality.
I know it sounds cold.
I mean, I read through these same institutional playbooks you have stacked up over there.
Yeah.
And I struggle deeply with the ethics of it. We are talking about the potential for widespread human suffering, global conflict, economic devastation.
Yeah.
And while everyday people are losing their life savings and worrying about the safety of their families, a fund manager in Manhattan is essentially looking at a spreadsheet and thinking, how do I position my portfolio to capitalize on this?
Right.
That sounds less like strategic investing and more like modern, digitized war profiteering.
I understand the instinct to view it that way. It feels incredibly cold. But the analysts writing these reports, they aren't operating on malice.
No,
they're operating on math. The institutions don't trade on a desire for conflict. They trade on the mechanical reality of what conflict does to a globalized economy.
they're looking at the supply chains.
Exactly.
Yeah.
Supply chains, commodity flows, sovereign debt. The source material outlines it perfectly. Conflict acts as an accelerant. It burns away all the market illusions and reveals who actually owns the underlying assets.
So wait, so you're saying peacetime markets are essentially built on illusions?
Completely. Think about the tech bubbles or the speculative manias we see when interest rates are low and the world is, relatively quiet.
Right. Everyone's throwing money at software.
Exactly. We price companies based on 20-year projections, hypothetical growth, abstract ideas. But the moment the geopolitical board is shaken like it is today,
All of that speculation evaporates.
it vanishes. Capital suddenly cares about tangible reality.
Right.
Who controls the energy? Who builds the security infrastructure? Who holds the physical assets?
The real stuff.
The real stuff. The institutional money is simply rotating their capital out of the illusion and into reality.
Okay, looking at it strictly as a survival mechanism, makes it slightly more palatable.
It's self-defense.
Right. It's not necessarily cheering for the war. It's acknowledging that the economic fallout is guaranteed, and they refuse to be the ones left holding the bag.
Exactly.
But to understand how they survive it, we have to break down the actual mechanics of this rotation. The retail investor is selling out of fear. But what exactly is the institutional side buying?
We have a very clear roadmap for that today. We are going to decode the exact mechanics of what the analysts call the oil shock.
Okay.
We're going to explore the defense ledger, looking at how government checkbooks shift during wartime. And finally, we will reveal the ultimate flight of capital to tangible safe havens.
By the end of this deep dive, you are going to understand exactly how capital reacts to global panic and, more importantly, how you can protect yourself from the fallout.
Let's start with the psychological divide you mentioned earlier, because the source notes spend a significant amount of time detailing this. They call it the desire loop.
The desire loop. This is the cycle of fear and reaction that traps the retail investor.
Yes.
And you have to look at this through the lens of recent history. Think about the painful lessons of the 2020 crash.
Oh, absolutely.
Or the sudden geopolitical shocks we saw in 2022. The average person has economic PTSD.
They absolutely do. When you log into your brokerage account during a crisis and see your net worth dropping by, say, 10 or 15% in a matter of days,
It's terrifying.
the neurochemistry of panic completely takes over. Your brain screams at you that the number is going to go to zero.
You just want it to stop.
Right. The desire for cash, for the perceived safety of holding dollars, becomes overwhelming. So you hit the sell button. You lock in those massive losses.
But mathematically, you're handing over your assets at a steep, steep discount.
And this is the other side of the trade.
Because every time a terrified retail investor hits sell, an institutional algorithm is on the other side of that transaction hitting buy.
I want you to visualize the imagery the analysts used to describe this crisis trade. Imagine a split screen.
Okay.
On the left side of your screen, you have the mainstream broadcast. High contrast red alerts, military maps, talking heads speaking in frantic tones.
The whole media ecosystem designed to induce anxiety.
Entirely designed to sustain it.
Yeah.
But on the right side of the screen, you have the silhouette of an institutional trader.
Sitting in a quiet room.
The room is completely quiet. They are totally detached from the emotional narrative, and they are calmly pressing a glowing green buy button.
They're stepping into the chaos with a very specific shopping list.
Yes.
They aren't buying the broad market. They aren't buying the consumer tech stocks that retail investors are dumping.
No, they are buying oil derricks.
Right.
They are buying heavy machinery companies. They are buying vaulted gold bars. They are buying the absolute bedrock of the physical economy.
Which brings us perfectly to the first major mechanical lever of this crisis. The files refer to it as the choke point and the stealth tax. Or, more simply, the oil shock.
The oil shock.
If we're going to understand how capital moves today, we have to look directly at the geography of the Middle East.
We need to pull up the data on the Strait of Hormuz. Because when you look at the topographical maps and the shipping lanes in these reports,
A nightmare.
the vulnerability of the global economy is absolutely terrifying. We are not talking about a vast ocean where ships can just alter their course.
No, it's a bottleneck.
A geographical bottleneck sitting directly between Oman and Iran.
And the specific dimensions of that bottleneck are what make it so critical. It connects the Persian Gulf to the Gulf of Oman and the Arabian Sea. But at its narrowest point,
It's tiny.
the Strait of Hormuz is only 21 miles wide.
21 miles. Think about that for a second. You could drive across that distance on a highway in under 30 minutes.
Yeah.
Yet nearly 20% of the world's daily oil consumption passes through that tiny sliver of water.
1 in 5 barrels.
1 in 5 barrels of oil that the entire planet relies on to function, to keep the lights on, to move trucks, to fly planes, has to squeeze through a waterway that is currently ground zero for a major geopolitical conflict.
You really cannot overstate the logistical nightmare this presents.
Mm.
We are talking about very large crude carriers, these massive supertankers that take miles just to turn around.
Right.
And they're trying to navigate a narrow channel while military vessels and drones are operating in the immediate vicinity.
And it's not just about the physical danger to the ships. The moment tension escalates, who steps in?
The maritime insurance syndicates in London.
That is a crucial detail from the notes, the insurance premiums.
Exactly. Lloyd's of London and other major insurers will immediately declare the region a war risk zone.
And what happens to the cost?
The premiums to insure a multi-million-dollar tanker and its cargo skyrockets by thousands of percent overnight. Sometimes the underwriters simply refuse to insure the journey at all.
Wow.
And if the ships cannot get insurance, they cannot sail. Period.
They just sit there.
They sit there. You don't even need a physical blockade to choke off the oil supply. The financial blockade of skyrocketing insurance premiums does the job just as effectively.
And the macro analysis predictions we are seeing regarding this disruption are staggering. The cold math of the market immediately prices in the risk of supply failure.
What are the numbers looking like?
We are looking at projections where crude oil could hit $100, $150, or even cross the $200 a barrel mark if this conflict escalates into a prolonged disruption.
A $200 barrel of oil fundamentally breaks the modern consumer economy.
It does.
And this is where the notes introduce the concept of the stealth tax. Because the average person thinks about oil prices strictly in terms of the number flashing on the sign at their local gas station.
Right. They think, okay, it'll cost me $20 more to fill up my car.
Exactly. They don't realize that high energy prices act as a massive hidden tax on every single aspect of their lives.
The inflation bleeds into absolutely everything. If the price of oil doubles, the cost of diesel fuel doubles.
Yeah.
That means every single physical good that needs to be loaded onto a truck, a freight train, or a cargo ship suddenly costs significantly more to transport.
Consider the supply chain of a basic consumer good.
Yeah.
Let's say a plastic children's toy manufactured in Asia.
Okay, walk us through it.
Well, the raw material for the plastic is derived from petroleum. That is cost increase number one.
Right.
Then it gets loaded onto a container ship powered by bunker fuel to cross the Pacific. Cost increase number two.
Yeah.
It lands at a port in Los Angeles and gets loaded onto a diesel truck to be driven to a retail store in Ohio. Cost increase number three.
So by the time that toy hits the shelf, the price has surged.
The price has surged and the consumer has to eat it.
And the same goes for the fertilizer used to grow your food, which is heavily reliant on natural gas and energy inputs.
Absolutely.
The cost of commuting to work skyrockets. The airline tickets for your family vacation double in price. This is the stealth tax. Your wages haven't gone up, but your cost of living is suddenly consuming your entire paycheck.
Which brings us back to the stock market and why the retail investor gets crushed while the institutional capital thrives. The reports outline this stark contrast between the S&P 500 bleed and the upstream energy rotation.
The analogy the source material uses to describe this dynamic is incredibly vivid. It perfectly illustrates the financial mechanics at play.
The gas pump analogy.
Yes, I want you to imagine a heavy industrial gas pump nozzle.
Okay.
Now imagine the thick black rubber hose attached to that nozzle, wrapping tightly around a fragile paper stock market ticker tape.
It's coiling around the tape like a snake.
Exactly, coiling and squeezing it. As the tension tightens, the numbers on the ticker tape are turning warning red and crashing downward. But the price dial on the gas pump,
It's spinning wildly upward in bright signal green.
spinning upward. That visual perfectly captures the reality of margin compression.
It really does.
Explain the mechanics of that compression for the listener, because that is the exact force destroying the value of retail portfolios right now.
Well, think about it from the perspective of a normal consumer company. Let's say a company that manufactures mid-range laptops or a major retail clothing chain.
Okay.
When the oil shock hits, their operational costs explode. As we just discussed, it costs them double to manufacture their goods and double to ship them across the globe.
Right.
But here is the trap. They cannot simply double the price of the laptop or the t-shirt for the consumer.
Because the consumer's already broke.
Exactly.
They're spending all their disposable income just paying for gas to get to work and groceries to feed their family. They aren't going to buy a new laptop.
Precisely. The consumer has zero purchasing power left. So the company cannot pass those increased costs onto the buyer.
So what happens?
The company has to eat the losses. Their profit margins are systematically compressed until they vanish entirely.
Wow.
Earnings reports come out, profits are down 40%, and the stock price absolutely craters. That is the heavy black hose choking the ticker tape.
And Wall Street sees this margin compression coming from a mile away.
They don't wait for the quarterly earnings reports to confirm it.
No. The moment they see the geopolitical tension at the Strait of Hormuz, they execute a violent rotation of capital.
The smart money moves.
They pull their money out of the vulnerable sectors, out of the tech companies, the consumer discretionary stocks, the retailers.
And they rotate that capital aggressively into upstream oil exploration and hard energy infrastructure.
They are buying the companies that pull the oil out of the ground,
Right.
the companies that refine it, and the companies that transport it through pipelines.
And by doing that, they're executing a closed loop of wealth transfer.
Walk through that closed loop.
Well, by owning the energy infrastructure, the institutional capital is effectively collecting the exact same inflation tax that you are paying at the pump.
Let that sink in.
When you pay an extra $3 a gallon, or when you pay higher shipping costs for your groceries, that extra money is flowing directly into the corporate revenues and dividends of the energy companies that the institutions just bought at a discount.
It is ruthless.
It's ruthless, but it is mathematically sound. They do not fear their inflation because they own the assets that directly benefit from it. You are paying the tax. They are collecting the revenue.
That is the fundamental difference in mindset. The retail investor fears the economic environment. The institutional investor simply acquires the assets that thrive in that environment.
But energy is only the first pillar of this crisis trade playbook. The notes make it clear that there is a second, equally massive flow of capital occurring right now.
We've covered the stealth tax.
Now we have to turn the page and look at the defense ledger.
This is where the cold math of Wall Street intersects directly with the political reality of Washington. The analysts refer to the specific dynamic as the blank check.
I have to admit, digging into the data on government defense spending during a crisis is incredibly sobering.
It changes your whole perspective.
It really does. Look at the economic reality we live in during times of relative peace. Economists often refer to our modern system as a fragile, debt-heavy trap.
Yeah.
During peacetime, Western governments are absolutely paralyzed by political gridlock.
Peacetime politics is a game of inches and endless friction.
It really is. Congress will spend months fighting over minor budget deficits. They argue endlessly over infrastructure bills, trying to find money to fix potholes or repair aging bridges.
Right, fighting over pennies.
They threaten government shutdowns over ideological differences regarding tax cuts or welfare spending. The system barely functions on a day-to-day basis without threatening a sovereign debt default. The purse strings are pulled incredibly tight.
But the forensic truth outlined in these institutional files shows a completely different reality the moment a crisis hits.
A total 180.
When conflict erupts, when those red breaking news banners regarding the U.S. and Iran flash across the screen, that political gridlock vanishes entirely. It evaporates overnight.
The speed of the pivot is breathtaking.
It is.
Politicians who could not agree on funding a highway repair bill last week will stand together tomorrow and unanimously approve hundreds of billions of dollars for national security.
Defense spending becomes the only truly bipartisan blank check left in Washington.
And institutional capital tracks the flow of liquidity.
Always. Right now, the largest, most reliable, and most immediate fire hose of liquidity on the planet is the government's defense ledger.
They know it's coming.
Wall Street knows that regardless of the economic conditions, regardless of inflation, recession, or consumer panic, the government is going to open the checkbook.
But the playbook notes a massive shift in how that defense capital is actually deployed in a modern conflict. We are not just talking about traditional defense contractors pumping out bullets and artillery shells.
No, the files detail a rotation specifically into the aerospace and cyber pivot.
This is a crucial distinction because warfare has fundamentally evolved.
The battlefield is no longer just physical, it is overwhelmingly digital.
Right.
Before a single physical asset like a tank, a naval destroyer, or an F-35 fighter jet is ever deployed to the Middle East, billions of dollars are authorized and spent on cyber defense infrastructure.
Think about the nature of the tension with Iran. The first shots fired in this kind of modern conflict aren't necessarily kinetic. They are digital.
We're talking about highly sophisticated state-sponsored cyber attacks.
Exactly. Targeting the U.S. power grid, targeting the banking system, attempting to disrupt communication networks and civilian infrastructure.
So the institutional capital isn't just buying the companies that manufacture munitions.
No, they are aggressively buying the elite cybersecurity contractors, the aerospace engineering firms, the companies that control satellite communication networks.
And the developers building AI-driven defense software, they're buying the digital firewalls.
Now, I push back on the ethics of the oil shock, but I find myself wrestling even harder with this defense ledger.
How so?
Well, investing in cyber defense makes sense, but
Yeah.
the broader rush to buy defense stocks the moment war looks inevitable.
Mm,
It feels inherently destructive.
it feels like betting on the worst case scenario.
Exactly.
Yeah.
You are essentially betting that the conflict will escalate because escalation equals higher revenues for
Yeah.
these companies. It just feels extremely dark.
I hear you, but the data tells a story of capital preservation, not malicious intent. Institutional money floods into the defense sector because of a concept the analysts call the mathematical guarantee.
The mathematical guarantee.
You have to compare a defense contractor to a regular consumer company during a crisis.
Okay, let's look at that contrast.
Take a company that manufactures high-end smartphones or luxury vehicles or even home appliances.
Right.
During a geopolitical crisis, when the stealth tax of inflation is destroying the middle class and people are terrified about the future, consumer spending plummets.
Of course. No one is buying a new luxury car when gas is $6 a gallon.
Exactly. Those consumer companies are incredibly fragile because their revenue relies entirely on the fickle desires and the disposable income of the everyday consumer.
But defense contractors do not rely on consumer spending.
No.
They do not care if the middle class is experiencing a recession.
Exactly. Their revenues are mathematically guaranteed by sovereign debt. When the U.S. government signs a contract with an aerospace firm for a 10-year satellite defense program, that money is locked in.
The government will literally print the currency or issue treasury bonds to ensure those contracts are paid in full.
And the structure of those contracts is what makes them the ultimate safe harbor for Wall Street. The notes mention the prevalence of cost-plus contracts in the defense industry.
Cost-plus contracts. This is fascinating.
It really is. Break that down. If you're a normal company and your raw materials get more expensive due to inflation.
Your profit margins shrink.
Right.
But with a government cost-plus contract, the government agrees to pay the contractor for all of their expenses, plus a guaranteed percentage of profit on top.
It makes them virtually immune to inflation.
Totally immune. If the cost of building the satellite doubles because of supply chain issues, the government just writes a bigger check.
And the contractor still gets their guaranteed profit margin.
It's unbelievable. In a fragile, chaotic economy where consumer demand is collapsing and inflation is running rampant, Wall Street flocks to the only sector where cash flow is guaranteed by the printing press of the state.
It is the ultimate hedge against a collapsing consumer economy. They are migrating to where the money cannot stop flowing.
Which provides the perfect segue to the final and perhaps most vital phase of the crisis trade.
Section 4.
Right. We have tracked how capital captures the inflation tax through the oil shock.
We have seen how it secures guaranteed revenue through the blank checks of the defense ledger.
Now we have to look at Section 4 of our files, the safe haven rotation.
Or what the analysts call the return to tangible reality.
This section outlines a profound shift in market psychology. They call it the death of speculation.
The death of speculation.
To really grasp this, you have to contrast the economic rules of a prolonged peacetime with the brutal realities of wartime economics.
Look at the last decade. We had an extended period of relative geopolitical peace, combined with central banks keeping interest rates artificially pinned near zero.
Cheap money.
Exactly. When money is essentially free to borrow, capital gets bored, it gets greedy.
It starts flowing further and further out on the risk curve, looking for massive returns.
And that environment creates a massive bubble in what the notes refer to as paper assets.
We saw it everywhere.
Everywhere. Investors were throwing billions of dollars at hyper-valued software companies that had never turned a single dollar of profit.
We saw the rise of meme stocks, where bankrupt retail chains were suddenly valued in the billions based on internet jokes.
We saw speculative cryptocurrency tokens with no utility reaching astronomical valuations.
In a low-interest peacetime environment, people are more than willing to pay exorbitant prices for the mere promise of future growth.
The market becomes a mechanism for trading abstract ideas rather than actual value.
But when bombs start dropping and global supply chains fracture, reality reasserts itself violently.
The bubble pops.
All of those paper promises, all of those abstract software valuations, they suddenly become massive liabilities.
If a company does not produce something tangible, if it does not generate actual free cash flow or manufacture a physical good or provide critical security infrastructure,
Its perceived value simply evaporates.
capital is terrified of the illusion and it demands a return to the real.
And when the illusion shatters, where does the smart money actually go to protect its core wealth?
The files refer to this destination as the golden anchor.
The golden anchor.
They execute a massive rotation into what the analysts classify as outside money.
The term outside money is critical here. The defining characteristic of outside money is that it carries absolutely zero counterparty risk.
Break that concept down for the listener, because counterparty risk sounds like a dense legal term, but it is actually the most important vulnerability in anyone's personal finances right now.
It really is.
What does it actually mean in practice?
Counterparty risk is essentially the risk that the person or institution on the other side of your financial agreement will fail to hold up their end of the bargain.
Okay.
Almost everything you own in the modern financial system has counterparty risk. If you own a stock, your wealth is dependent on that specific corporate management team succeeding.
Right. If they fail, your stock goes to zero.
And it extends far beyond just stocks.
Absolutely.
If you own a corporate bond that is just an IOU, you are trusting that the corporation won't go bankrupt before they pay you back.
Even the cash sitting in your traditional bank account has counterparty risk.
Yes. Your cash is legally a liability of the bank. You are trusting that the bank remains solvent.
If the bank fails and the government safety nets are overwhelmed, your access to that wealth vanishes.
You are reliant on a web of promises.
So outside money is an asset that exists completely independent of anyone else's promise.
Exactly. It doesn't require a management team. It doesn't require a solvent bank. It doesn't require a functioning stock exchange.
And historically and currently, the ultimate form of outside money is physical, vaulted gold and silver.
This ties directly into the macro trend the files call the tangible asset regime.
The tangible asset regime. If you look at the forensic data tracking the behavior of global central banks and ultra-wealthy family offices over the past few years, they have been quietly accumulating physical precious metals at a record historical pace.
They've been backing up the truck.
Even before the current U.S.-Iran tension reached this boiling point, the elites were stacking gold.
And the data in these files forced me to completely reframe my understanding of wealth preservation. Because I will admit, for a long time, I viewed gold investors through a very specific, somewhat dismissive lens.
Okay, be honest.
I thought of them either as eccentric doomsday preppers hoarding coins in a basement, or as speculative day traders just trying to get rich quick off a sudden price spike.
But institutional capital does not view gold as a speculative trade.
No.
So what does the math actually tell them? Why are the family offices and the central banks buying it by the ton?
They do not buy precious metals to get rich. They buy them to ensure they do not go broke.
It's a defensive play.
It is an act of mathematical self-defense against the actions of their own governments.
Think about the entire cycle we just discussed. When a global conflict erupts, the government authorizes unlimited blank checks for defense spending and cyber infrastructure.
Right.
How does the government actually pay for those blank checks?
They certainly can't tax the population enough to cover a multi-trillion-dollar wartime deficit.
No, especially when the middle class is already being crushed by the stealth tax of inflation we talked about.
Raising taxes during an economic slowdown is political suicide.
Exactly. They can't tax their way out of it, so they do the only thing a sovereign government with a printing press can do.
They debase the fiat currency.
They instruct the central bank to print trillions of new dollars to fund the foreign conflicts and domestic stimulus programs.
And the math on that is brutal. Every single time the central bank prints a new dollar and injects it into the system, the dollars you are holding in your savings account lose a fraction of their purchasing power.
Your savings are silently diluted to pay for the war.
That is the core realization. Gold is the ultimate forensic anchor in a sea of geopolitical liquidity. You cannot print a gold bar.
A central bank cannot arbitrarily double the supply of physical silver to fund a defense contract.
When the institutional elites move their capital into vaulted physical gold, they are simply building a firewall.
They are protecting the purchasing power they have already accumulated from the mathematical certainty of wartime currency debasement.
They know the government is going to devalue the currency, so they step outside the currency.
It is purely about financial survival.
Which brings us to the most important part of this deep dive. We have laid out the entire crisis trade.
We have tracked how the institutional money profits from the margin compression of the oil shock.
We have seen how they secure guaranteed revenue through the blank checks of the defense ledger.
And we have examined their flight to the zero counterparty safety of tangible safe havens.
Now we have to open Section 5, The verdict and the survival playbook.
We need to synthesize all of this forensic data and extract the actionable mindsets for you, the listener.
Because ultimately, you are not a hedge fund manager.
You cannot control the geopolitical chessboard. You have absolutely no say over what happens in the Strait of Hormuz, what military responses are authorized, or what spending bills get voted on in Washington.
But you possess complete control over where your capital sits when the board is shaken.
Actionable mindset number 1 is the most critical and, honestly, the hardest to execute.
Stop panic selling.
Stop panic selling. You cannot let a red breaking news banner dictate your financial future.
When you are watching the broadcast and you feel that knot forming in your stomach, you have to recognize it for exactly what it is, an engineered emotional response.
Remember the split screen visual we talked about. When you log into your account and sell your assets out of fear, you are essentially tricking yourself into giving Wall Street your hard-earned wealth at a massive, massive discount.
You are personally funding their crisis trade.
I know it goes against every human instinct, but the data proves that the most profitable thing you can do during a moment of profound market panic is absolutely nothing.
On your hands.
Turn off the television, let the emotional wave pass, and then objectively look at the underlying math of your portfolio.
Which leads to actionable mindset number 2.
Audit your energy exposure.
We have established that if we are entering a period of prolonged tension and supply chain disruption in the Middle East, inflation is going to be incredibly sticky.
The stealth tax is going to bleed the consumer economy dry.
The playbook emphasizes the absolute necessity of owning a piece of the choke point.
You need to look at your investments and ask yourself a hard question. Do I own any hard energy infrastructure?
Do I have exposure to raw commodities, upstream oil producers, or the pipelines that transport the fuel?
Because if your portfolio is entirely concentrated in consumer tech and retail, you are entirely defenseless against the margin compression this conflict is causing.
If you don't own the energy assets, you are paying the inflation tax at the gas pump in the grocery store, but you are not collecting any of the revenue on the back end.
You have to align your capital with the reality of the supply chain.
And finally, actionable mindset number 3.
Bolster the tangible firewall.
We just walked through the inescapable math of sovereign debt. Geopolitical conflict guarantees massive deficit spending.
Massive deficit spending guarantees money printing.
And money printing guarantees the rapid debasement of fiat currency.
Therefore, moving capital into physical, vaulted precious metals is not an optional luxury.
No.
It is not a speculative gamble hoping the price goes up. It is mandatory financial insurance.
You have to ask yourself, are you treating gold and silver as an investment to get rich, or are you treating them as insurance to stay solvent?
Because the smart money views them entirely as the latter.
It is the heavy anchor that prevents the ship from drifting into the rocks during a Category 5 economic storm.
That distinction leaves us with the ultimate paradigm shift, the guiding philosophy of institutional capital during a crisis.
The analysts summarize it beautifully. The smart money does not fear the storm. They build windmills.
I love that analogy.
It's perfect.
They recognize that the geopolitical winds are going to blow regardless of how they feel about it. They don't waste time wishing for clear skies.
Instead, they ruthlessly build the infrastructure to harness the energy of the storm.
It is about financial self-defense, preparation, and alignment with reality.
But before we wrap up this deep dive, I want to pose one last puzzle, a devil's advocate prompt for everyone listening to mull over today.
Lay it out.
We have just spent an hour outlining the precise mechanics of the crisis trade. We know how the defense and oil sectors capture the capital and how gold acts as the ultimate anchor.
Right.
But if we know this, and the institutions know this, and it is a documented historical playbook, aren't these assets already perfectly priced in by the market?
That is the multi-million-dollar question, the efficiency of the market.
Think about the technological reality of modern finance. The massive institutions employ supercomputers and algorithmic trading programs that execute trades in fractions of a millisecond.
They scan news sentiment, social media, and satellite imagery instantly.
By the time you, the retail investor, see the breaking news alert about an incident in the Strait of Hormuz on your television screen, the smart money algorithms have already executed the rotation.
The trades were placed before the news anchor even finished reading the prompter.
Exactly. So the question is the crisis trade actually too late for the average person to act on by the time the panic is public?
Have you already missed the window to protect yourself?
Or is the fundamental geopolitical shift so massive and the unwinding of the global supply chain so complex that this rotation of capital will take years, maybe even a decade, to fully play out.
That is a phenomenal prompt to leave you with. It forces you to think not just about what to buy, but to understand the timeline of when the macro transition truly happens.
We want you to consider how this immediate geopolitical chaos in the Middle East ties directly into the much larger, slower-moving, tangible asset regime the elites are currently building.
This isn't just a brief reaction to a single weekend news event. We are witnessing a fundamental generational restructuring of global wealth.
And I think that is the true value of unpacking these institutional playbooks.
It's not about trying to day trade the breaking news.
You will lose that game against the algorithms every single time. It is about taking a step back, looking past the warning red banners, and aligning your long-term capital with the undeniable physical realities of the macroeconomic landscape.
You cannot day trade a paradigm shift.
No, you can't.
You have the forensic files. You understand the mechanics of the oil shock, the defense ledger, and the tangible firewall. Now is up to you to look at your own portfolio and start building your windmills.
Stay entirely focused on the math, protect your purchasing power, and remember,
The future belongs to the owners.